Welcome to Travisa Financial. Travisa Financial is a purpose-driven wholesale lender. We're not your average wholesale lender. We're a team on a mission to help you open more doors.
Is offer products to home buyers that otherwise would not be able to get into a home. And there's so many.
Reach more families and redefine what's possible for first-time homebuyers, especially underserved communities.
Having diverse lending products opens doors for folks that otherwise might not have access. And so it's understanding different cultures, it's understanding different backgrounds, and the fact that you might not have had the opportunities that others have had, but there's still a way for you to get into homeownership. And so understanding that those different backgrounds exist.
At Travisa Financial, we believe homeownership is more than just a transaction. It's transformation. It's the foundation for building wealth, stability, and legacy. Together with borrowers, we're committed to making that transformation real. Through education, transparency, and heart, we help more families step confidently into homeownership.
It seems so much further away that it's more important today to focus on this affordable lending issue, right? Or the affordable lending challenge to get people into homes.
Because when you know better, you build better. Every borrower you empower, every loan you close, every set of keys you deliver is proof that dreams don't have barriers, only bridges.
For Travisa, it's putting some strength on that bridge, because how you help a broker close a loan, the understanding of the dynamics of that consumer who's now getting older because it's so much harder, who has profiles that we're all trying to figure out, right? When you talk about millennials and Gen Z and their income and all that. And a lot of lenders go, this is just too much damn work. And I don't know if I want to do this because it might not be worth it. I don't know how to manufacture this. Where Travisa can come in and go, look, let's manufacture loans and let's help brokers get these people across, and let's strengthen the bridge, right? It's going to take us some time. It doesn't happen like overnight, but we know how to do it pretty well.
Join us in building bridges that turn the dream of homeownership into reality. Because at Travisa Financial, no one serves first-time homebuyers better.
Welcome to our Travisa Financial Masterclass. I'm so excited that you guys could come and join us today. We have some really exciting things going on to share with you, a lot of good information. Currently, we are just waiting for our special guest. So I'm going to go ahead and go through a few of the information that I have for you. I'm going to go ahead and introduce a few of the guests that we have. And I'm going to introduce my co-host.
Hi, Monique.
Hi, how are you? So my co-host today is Fernando. So let me tell you a little bit about Fernando. He has some national recognition here. He is Scotsman's Guide Top 1% Loan Officer. He is NAREP's Top 250 Mortgage Originator and more. I think we'd be sitting here all day if I went over all of it. So I'm so happy that you're here today.
Yeah, thanks for having me.
Yeah, so Fernando is actually the president of our retail division, Altera Home Loans, right now currently. And he is going to be having a fireside chat with this guy here, Shawn King. So Shawn King is the executive vice president of Arrive Home. He is a co-founder as well. And so he has a lot of information to share with us about EEP, DPA Advantage, and definitely excited to have him joining us here shortly. So what I'm going to do right now, though, is while we're waiting for Shawn to join us, I'm just going to go over a little bit of information that I have for you all. And maybe if somebody could stop me as soon as Shawn is here.
I'll tell you what, Monique, I'll keep a lookout, and then if I see Shawn, I'll give you a little nudge, and then we can
Yeah,
transition.
perfect. So much appreciated.
Yeah, of course.
Okay. Whoops. So a little bit about myself. Again, my name is Monique Manaya, and I've been in the mortgage industry since 1997. I have been in all of the arenas from broker, retail, wholesale, processor, loan officer, branch manager. And most recently, I was the EEP production manager over at the government entity. So I led the EEP operations for them. I manage the processing, closing, funding, the signers over at the tribe, and also the title company approval desk. So during my time over there, I helped put a lot of processes and procedures in place. I was also on the underwriting guideline committee and was able to contribute across a lot of different departments as well. This program is extremely near and dear to my heart because of all of that time that I've spent working on it. And now here over at Travisa, I am excited to help you guys grow your business. Not only EEP, but also our Advantage DPA programs. We also have the standard FHA conventional VA loans that we're here to help you with. We have an amazing team. So this is our team of account executives. We have Ben Slayton. He's also our head of business development, and Norma Summers, both amazing. They bring a lot of expertise to the team and are always available to help you. One thing that we like to definitely do is we want to make sure that you understand not only the programs, but also the process. So we are here to set up any type of meetings, trainings that you guys need that you feel like would be beneficial. We don't want you to head into it wondering what's going on. How do I do this? We want to make sure that you're not confused and know everything so that you can move forward confidently. So Travisa Financial, one reason why I love Travisa, and this is the company I picked to come over, is because creating wealth through homeownership. There are a lot of homeowners out there that just they don't fit in that traditional mortgage box. And so when you don't fit into that traditional mortgage box, most of the time your option is sitting on the sidelines, waiting for your credit to be repaired, waiting for your, to be able to come up with 12 months bank statements to income qualify, or your sourcing and seasoning of your down payment, or your bankruptcy to season. So a lot of people have to sit on the sidelines and just wait. The amazing thing about Travisa is that we want to make sure that everybody has that opportunity for that generational wealth. And we also we serve first-time home buyers better than anybody out there. So we definitely want to bridge that gap to homeownership. And so this is one thing that this EEP program does. It allows you to help take those home buyers that just don't fit that traditional box and get them into homeownership now. So specifically that earned equity program. So the earned equity program and how it works. You have your home buyer that doesn't qualify for that traditional financing. We can have the home buyer get approved through the EEP program, which has the guidelines are a lot more flexible than the traditional mortgage guidelines. And so this is how we're able to get them approved, is we have the government entity that will purchase the home that your home buyer goes out and finds. And so they're not restricted to just seller financed homes out there. I know that if, 20 years ago when I was in this situation where I couldn't purchase a home, I started thinking about option with seller contracts. And as I was out there looking, there was not very many offered. And when I when I did go out and look at the homes, they weren't always the best. And so this program allows your home buyer to go out and pick the home of their dreams. So they will get pre-qualified EEP. They will go out, pick the home of their dreams. They will put it under contract, put the earnest money down. And then we have an assignment addendum. This assignment addendum is signed by your home buyer, the seller, and then we have it signed by the government entity, and this assigns that purchase contract over to the government entity. We then in turn complete the FHA financing through Travisa for the government entity, while your home buyer is getting approved through the tribe's underwriting process, getting vetted to make sure that they meet their guidelines. When everybody is CTC'd, simultaneously, our home buyer will be signing a homeownership finance agreement with a memorandum that is recorded on title, and the government entity will sign those FHA loan docs. And this memorandum of homeownership finance agreement that's recorded with the county and on title, that gives your home buyer the interest in the property, and really, gives them that security and that feeling that, this home is mine. So it looks like Shawn has joined us. So I'm going to go ahead and yay. I'm going to take a break here. And again, I'm going to turn it over to Fernando and Shawn.
Thank you, Monique. I appreciate it. And Shawn, glad you're able to join us. For you guys that noticed, Shawn likes to rock some white glasses, and I copied him and went with the blue ones today. So in honor of Shawn, I went with some stylistic creativity here.
You look amazing. I'm sorry for being a little bit late to this. Normally, Marcy sets this up for me in my calendar, but I had some link that took me to a different meeting. So Héctor saved the day and took care of us. So I apologize for that.
You know what, Shawn, I'll start. I'll take a few seconds just to introduce you to the rest of the crew. For those that don't know, Shawn King is the Executive Vice President of Sales at Arrive Home, which is a national affordable housing program, providing down payment assistance and alternative credit solutions for underserved communities.
Perfect.
I've had the pleasure of working alongside Shawn in a partnership capacity for 3 years now, Shawn, and I think we've had a lot of success together. And I'm excited to hear what you got to say, and hopefully we can get this chat going back and forth, because I think you guys have an awesome program that brokers now have the opportunity to participate in and kind of spread the word.
It's fantastic. No, I'm excited to be here. Thanks very much for the time and putting this together. So
yeah. So quickly, you have two programs that are kind of the heavy hitters for Arrive. And my hope is that we get to touch on both of these. One of them being the Advantage DPA program, and the other one being, and I think Monique started touching on it, which is their EEP, which stands for Earned Equity Program. Let's start with Advantage DPA. If you want to just go ahead and jump right into the highlights of it and how it can provide value to a lot of our guests.
So you probably don't realize this, all the brokers that are out there, the majority of you, I don't know what your access is, right, to housing finance agencies, but the majority of you probably don't have direct access. But the great thing about working with Travisa is you'll have about as close as direct access in terms of pricing through what they put together with their Advantage DPA program, because they have what's called a white label retained servicing option through us, which means that they securitize the first mortgages and hold them themselves. The majority of your housing finance agencies throughout the country are requiring the lenders, the originating lenders, to sell the loans to them, right? And so then there's this kind of in between, this middleman that takes some of that, what's called spec pay up, right, in the secondary markets. So you're gonna basically benefit potentially from a better situation by working through Travisa, because they are able to securitize these FHA loans directly and provide down payment assistance through our program through the Tule River Tribe of Porterville, California. So a lot of people, again, they also don't realize that how can you do down payment assistance? What are you? And as you know, there's 5 sources for FHA for down payment, right? You can provide it yourself. You can get a relative to do it. You can get a gift. You can have an approved nonprofit. And the other one is a government entity. So Native American tribes are considered a government entity. We're a federal instrumentality agency of the government since 1934. We work in every single state except for New York. And you don't have to be a tribal person to work with this program. It's just anybody that can qualify for an FHA loan. We offer a 3.5% and a 5% down payment repayable. And then we also offer a 3.5% forgivable, which is forgiven after 36 months. So typically your repayables will be better pricing. You'll be able to get into lower interest rates. But I would say one of the benefits again of working with Travisa is you'll be able to compete better than some of the other options that are out there, because a lot of the other options, they require that loan to be sold, and that takes some of the spin off the ball in terms of pricing. Travisa is keeping that kind of all in house for you guys, so you can offer a better situation.
That's awesome, Shawn. Real quick, so obviously when it comes to the DPA world, there are a ton of options out there. They have their HFAs, they have other Native American bands that are doing similar things. If you could pinpoint, let's go 3 or 4 of the top advantages of using your Advantage DPA program, or Travisa's Advantage DPA program, versus some of the competition out there. Go.
So yeah, I mean, almost the credit box is always a big deal. You guys determine the credit box. So Travisa will determine the credit box, and they'll determine the risk that they're comfortable with. Almost all of your housing finance agencies are a 640, they're a 50, whatever, 45 DTI. They have income limits, that kind of thing. There's some flexibility in what you guys come up with to do that. And so you have the ability to look at the risk yourselves and be more flexible to acquire more business. So that's one of the big things. There's no special forms outside of standard FHA stuff. You'll get a lock through Travisa, and then you have what's called a funding obligation form that we provide on every one of these. It's like a secondary lock document. That document governs the second mortgage, but that's the only unique document to this. Imagine not having a separate underwriting or QC review or anything like that on these transactions. This is the easiest down payment assistance program to use in the country in terms of forms. They're all Fannie Mae forms, with the exception of just the funding obligation letter, which happens through the lock process that Travisa handles for you.
So am I hearing you say simplicity is right up there as one of the key drivers of this? If we can get a loan closed quicker, easier, why not, right?
Yeah, exactly. It's much easier, and you'll have less pain damage in working with this.
When it comes to credit risk, you mentioned a lot of the competition's hanging out at 640. Travisa goes down to 600 with manual underwrites allowed. Can you expand a little bit on maybe highlight what kind of flexibility that allows our consumers?
I mean, it's a huge niche. It's a huge niche, especially manual underwrites. Sometimes, for whatever reason, we're seeing with AUS that things are giving you a refer when it doesn't make a lot of sense. And then maybe you move it to a 25-year note, and then suddenly it goes. And there's just a lot of weirdness sometimes with the automated underwriting systems out there. And you've all experienced it. You've all experienced where you're pulling your hair out and you don't exactly understand. It worked. It seems like it worked 2 months ago with the borrower that's very similar. So this manual underwriting is a very big thing. And I would say the lion's share, probably 95% of the housing finance agencies, they won't touch a manual underwrite. They're stuck on that 640 box, that kind of thing. And there's a huge gap. If you figure the mean for what we do is about 667, right? That means that probably half of the originations that we're doing are under that 640, right? They're below 640 on using our program. So it's a huge market, and we facilitate about 13 to 1400 units a month of this program, so nationwide.
That's awesome. And you're capturing a lot of the underserved markets that doesn't have the opportunity for a DPA. We like to say, these HFAs, and they do to an extent, these HFAs help underserved communities, but underserved communities typically struggle with that credit score for various reasons.
Right.
And you guys can plug that hole.
That's right. Absolutely.
Yeah. DTI, are you as aggressive is it full FHA DTI, or how's that work?
Yeah, again, you guys get to determine that. If you want to go straight.
All right, so I'll go ahead and say 46.99 over 56.99. It is as aggressive as you can get in the lending space.
Perfect. Yeah.
And for everybody on the call, you guys know, we as lenders, we tend to live in that 46.99, 56.99 space. And this is an awesome option in the DPA space. Concessions, seller concessions up to 6%, same as FHA, correct?
Yep. And again, just follow QM guidelines for what you charge on the front of the loan. You can get all the seller concessions that you need. So,
and you can get up to, you said, a 5% on the DPA?
Correct. You do 5% on a repayable. And so it's a 10-year AM on that. It's going to be 2 points higher than the first. And that's just how we do it. The reason for that is we sell off those second mortgages, and we have buyers. So it's not like FHA where you have hundreds of buyers that'll buy an FHA loan. You got like maybe 20 buyers in the country. And that 10-year AM with 2 points higher seems to be the one that pays the best. So that's the construction that we use, and that in turn gives you the best pricing. So,
and if they take the forgivable option, can you expand a bit on that?
Yeah, so that'll be a 0% 30-year term, no payment on the second mortgage. It's forgiven after 36 months, but you got to be very clear with your clients. They have to make all 36 payments on time. Otherwise, the clock resets. So it's theoretically possible you can make 35 payments and then missed your 36, they'll be late on it, and then the clock resets. So just do all 36 on time so you can get the forgiveness on that.
So even if you, let's say month 18, you're hit with a late, it's not thrown out the window. It's just a reset of the clock. You got to wait another 36, correct?
That's correct. Yeah, it just resets the clock. Correct. Yeah, the whole time you're not making payments on the second mortgage. You're just making sure you're paying your first mortgage on time on that.
Awesome. I don't know, Monique, is this open up to questions? And if you are, go ahead and let me know if we have any. And if not, I want to jump right into the EEP, which is obviously the really exciting portion of this program.
Yeah, no, we can definitely go into some questions. If anybody has any about the Advantage DPA before we go into the EEP with my good friend Shawn and Fernando, go ahead and please raise your hand. I'm not sure. Looks like our chat is open. So if you want to also use the chat, then you can go ahead and do that.
Awesome. If something comes through, just let me know. We'll jump back to it. In the meantime, folks on the call, if you're not paying attention, now is the moment to pay attention. We got Lydia. Go ahead, Lydia.
I just want to say that the chat is disabled. Can you able the chat so we can actually type into it?
Oh, yes. Efren or Carla, can you can you enable the chat, please? Sorry about that. Usually I have a Q&A box when I do my webinar. So my Q&A box was gone. I was a little stumped there.
Okay. It's open now.
Oh, good. Okay. Perfect. Thank you.
Mm-hmm.
All right. I was trying to build up the hype for EEP because our team across the country has experienced a ton of success on it. And Shawn, we'll let you kind of get into the nitty gritty as to what it is. But before we go, I'm going to spit some numbers out. And I want the audience to really grasp how important this number is, because there's two things: the amount of volumes our team is closing, the amount of volume our team is closing with this, the amount of units it's closing with it, and the opportunity it has to open doors not only for the consumers but for you guys as lenders with your referral partners. So for Altera Home Loans in 2025, year to date, just 2025, and Shawn, I don't even know if you know this number yet, but we've closed $132 million of this product with 374 units. With our biggest markets being in Colorado, Texas, SoCal, Las Vegas, and Oklahoma. To give some context as to what that looks like in growth, in 2024, the totality of the year, we closed 121 million for 298 units. That we're on pace this year for 430. That's a 40% increase year over year just on this volume. So if you think that there isn't an opportunity to grow your business with this, we're about to spin your head on this, because there is amazing opportunities around the country. It's used for a variety of reasons. It's not just I-10, and Shawn will get into a little bit of that as I pry these answers out of him. But if you're looking to grow your business, link up with Travisa. Again, 40% year over year with the teams I oversee. I am a big believer in this product, and Shawn knows why. So Shawn will dive right into the EEP. You want to just give us first? Go ahead, Monique.
I'm sorry. We have two questions on the Advantage DPA. Mm-hmm. So the first question is, can the DPA be paid off early?
The answer is yes. You can pay it off at any time, but we will not subordinate that repayable one. So the subordination, there's a non-subordination period for 3 years, which means you can't do a streamline refinance. So if they want to pay it off, they can, but no subordination.
Okay, perfect. The next question is, for DPA, can you use bank statements?
It's FHA guidelines on it. So if you were doing FHA and it worked with FHA, then yes, that's fine.
All right. That's all. Thank you.
Okay, right. So you want to talk about earned equity. So I remember the exact moment when we talked about earned equity with you. Do you remember that? Where were we? We were in San Diego. Do you remember this?
We were in San Diego at an NAREP event, if I'm not mistaken.
NAREP event, and you guys had a dinner there.
Yeah.
And you were still a young, hungry, like regional guy.
Whoa. What do you mean? I was a young, hungry guy.
You're older. That was a few years ago.
I'm older. I wouldn't qualify myself as old.
You've come into your anyway, so whatever. I have a gray beard.
The presidency has given me a few gray hairs.
That's true. Managing people. So, okay, I mean, this started, let me tell you the story of how this started. At the previous company we worked with, we purchased a HUD home, or I can't remember if it was a Fannie Mae distressed or a HUD home for like $1, right? We bought it in the St. Louis area. And we did that with the idea of we were going to rehab this property and then sell it, right? So We put the money into it to rehab it. It was a terrible experience in trying to rehab it. We had appliances getting stolen. People were coming in. We had to post security there on site to protect the property. Not a great neighborhood, but the community kind of gathered around this property because this was just a terrible block, right? And so it just had a lot of dilapidation. And this property was like a new breath of life, right? And so there were a lot of people that were looking at it, thinking about it, wanting to get in there. On the day that we opened up applications, mortgage applications to have this property, we had like 130 applicants. Okay. Every single one of those applicants could not qualify for an FHA loan for some reason. Okay. And this is the shame of the whole thing. They couldn't qualify for an FHA loan. But when you looked at their equivalent rent payments, they were making an equivalent rent payment that could cover the cost of this property, the mortgage.
On time,
Right?
I imagine.
On time. They were on time. They could show that they had on time, whatever, but their credit, their this, that, there's a variety of reasons. And we all know who these clients are, right? For whatever reason, they're outside the reach of traditional FHA financing. They're outside the reach, right? And so we said, you know what, we're gonna do a lease option or something with one of these guys. We picked the most worthwhile candidate, and they were elated to be able to get into this brand new home on that street and kind of be the star, really, of the story. And so that's where the earned equity program started for us. And we connected with another entity for a period of time, but basically we think that we've built the best mousetrap in the country. So when you got somebody that's an FHA near miss, right? They have verifiable assets, income, and housing history. That's kind of the three things. This isn't like a garbage barge for FHA turndowns, right? If they have verifiable assets, income, and housing history, then we typically can work with that client. And it's great for people that are I-10s. Obviously, the I-10 community is a strong proponent. We're strong proponents of that. We do a lot of work with NAREP nationally, but it also works for somebody that's self-employed that doesn't have enough time documenting their work. It works with somebody that has permanent visa status but no longer can qualify as of May 25th. It works with people that we had some lady that she co-signed on a car loan with her parents 2 weeks before closing on a new home build. She'd already picked out the cabinets. The flooring's already in. She's elated that she's going to be able to move into her property. And then her credit score takes a dive. She's not able to recover quickly enough. What's she going to do? She wants to retain the property. She loves the property. So we step in, we purchase the property, and then we put her into this agreement that grants control, but allows her to move forward, fix her credit, and then take over and do some kind of, assumption or whatever, sell the property, where she's not selling an assumption of the FHA loan. So there's a lot of applications for it. Just think about it in terms of how many turndowns on FHA loans do you have? Could you capture?
And you know how long I've been lending. I have no idea if I had to quantify how much, every year it's, 20, 30 deals out the window.
Yeah, exactly. And so if you could capture 25 to 50% of those, right? What does that do? What does that do for your business?
Yeah, you're not kidding.
If you can go into markets, and there's a group of people that have been on the sidelines, because the only option for like the I-10 community or non-QM is 25% down plus points, right? You all know this. And so there's these group of people that maybe they have 7% that they've amassed, right? But they don't have the 25 whatever percent to do some of these other programs that are out there. And so they've had to sit on the sidelines, and maybe they're willing to take a property that isn't pristine, that isn't the best price or whatnot, but they've got the income, they've got some of the assets, they're just not quite there. This helps bridge the gap. And then they can use the economic engine of real estate to get into a better situation and basically build the equity on the property as they go. So what we do is we buy the property as a government entity. And a lot of people don't realize this. In the HUD 4001, it's called the investment property exception. And it basically says that investment properties are eligible if you're an instrumentality of government. And so we do the FHA loan. We are the borrower on the loan. So on the promissory note and the deed of trust, we the tribe, to the Two River Homebuyer Earned Equity Agency, is on those documents, right? And then we give a agreement to your clients that basically allows them to retain control. And then as Monique was saying, we file a memorandum at the county, which grants security. So that memorandum, we've had a couple of title attorneys look at this. They're not going to touch that with a 10-foot pole unless that thing is cleared off. They will not reinsure the property. So everyone has concerns that with these type of lease option programs or land installment contracts or whatever they are, that we're going to take their money and then we're just going to sell the property to somebody else. But with this encumbrance that we create on title, a title insurer looks at it and says, we can't reinsure this property until that encumbrance is dealt with. And it takes a pretty stiff power of attorney to unseat that. So you have security in the agreement.
So consumer A buys property through EEP. 6-7 years later wants to sell it. There's $75,000 worth of equity. How much does the consumer keep? How much does Arrive keep, or is it all to the consumer?
So everything north of the sales cost, right? So they're going to pay for the real estate costs and all that blah 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 to sell it. Everything north of that is theirs. There's no equity split or share.
So the equity is theirs. Any earned equity belongs to them, which is why it's called earned equity program, correct?
Correct. Exactly.
Awesome. And then that's protected through that assignment addendum that is recorded at the county.
Correct. Exactly.
And you guys sell it? Can you guys do anything without the consumer being involved?
We can't. Well, we can, but we have to meet the terms of the power of attorney to do that. And they're pretty stiff. We have to be able to demonstrate that they've abandoned the property.
No different than a foreclosure.
Yeah. And so we have to be able to demonstrate that stuff. Exactly.
We got Lydia's asking, how does the entity purchase the property on behalf of the consumer? Make a profit.
How do we make a profit?
Yeah, I'm assuming she's wondering what's the advantage to the entity? Why would you guys?
So we talk about, okay, so basically we take a 30-year FHA loan. That's what we pay. And then we take that payment, we add half a point. That's the consumer payment, and we cast it over 40 years. So that naturally creates kind of a small gap over the amortization history, right? That's what we book to our balance sheet as an asset. That extra half point is what we're keeping as revenue every single month for a servicing fee. And then we take upfront fees and securitize the loans. So we're making money on the securitization. We make a half a point annually on the payments. And there's a slight amount that the tribe gets to the balance sheet in the difference between a 30-year and a 40-year amortization. That's
a great question.
Yeah, it's a great question. But basically, you just have to focus on their amortization, not ours. Like it's almost like retail wholesale, right? Not in a lending sense, but like you go and buy the clothing at a retail and there's a wholesale price on it. We have the wholesale price, they have the retail price. The difference in that is what we keep, right? But if they pay off the retail price of the property, everything north of that is theirs.
Is it etched in stone that the consumer will own the property in 3 years? I'm unclear how soon the ownership will transfer to the consumer.
Not 3 years. So it's a 40-year agreement, right? So instead of a 30-year FHA, it's a 40-year agreement with them. If they pay off the agreement early, it's their property. If they stay in it for the full 40 years and pay it off, it's their property.
So no different than typical, like a regular loan, right? If you pay it off early, it's all yours. If you refinance out of it, because now you qualify for conventional financing or FHA financing, it's all yours.
Yes. At the end game, you own the property. Like you pay everything, you own the property. That's how it works. Probably the most easy construction to compare it to would be like a 99-year lease with an FHA, right? So we use a ground lease or some kind of similar construction to facilitate this rather than a note and a deed of trust. And on a 99-year FHA, what happens is you own the improvements, but the entity or whoever it is controls the ground, and they lease that ground to you for 99 years. But the difference is when that property gets conveyed with a 99-year lease, the ground reverts back to the original owner, whereas with us, the ground converts to the new owner, to you, right? So you get the whole thing. And so sometimes we get people that are frustrated, and I really like to talk about ownership and security. Because in the United States, what is ownership? If I were to ask the group here kind of a trick question and say, what do you own with the lease? Do you own anything with the lease? The majority of you as loan officers have been in the business for a long time would say, no, I don't own anything with a lease. I own nothing, because we've been conditioned to think that ownership is deed of trust mortgage and no ownership is lease. But the truth is neither one of those is 100% true, right? On a mortgage deed of trust situation, you have a trustee that can foreclose on you if you don't pay on time, right? If you don't pay your taxes, you can have things happen to you. You can't just do whatever you want. It's not absolute ownership, right? And on a lease, you own the right to periodic possession. So at law and at contract, if someone tries to unseat you from the lease and you've been paying on time and everything, you have recourse. They can't just do that. They can't get rid of you. So you own that right to periodic possession. So ownership is a grouping of rights and security. We've talked about security, but the rights are the right to convey the property is probably the single largest right that you get when you quote unquote own something. And you absolutely control that right with this agreement. You absolutely can say, I want to initiate a sale. Even if I'm going to lose money, I want to sell it. That's up to you. You can do that. I want to, improve it. You can do that. You check in with us just like you check in with an HOA.
So Cassandra, really quickly, just touch on the improvements. If you want to elaborate a little bit on that, and it sounds like you were about to.
Yeah. So improvements, basically just reach out to us and let us know what you're doing, just like you would with an HOA, right? Or a municipality. Anything that requires a building permit, we typically want to be involved to talk about that and just say yes on it. So
regarding title, taxes appear under the government entity, correct?
Correct. Yeah, but that's passed through to you in the form of a payment.
Got it.
Yep.
Juanita, I hope that answers that.
Yeah, good questions.
There are other programs out there similar to this. Some of them require renter's insurance. Do you require renter's insurance?
It depends on the state that you're in. So the agreement, so the state dictates the agreement, right? But the majority of these, we're going to do an HO3 policy instead of a DP3 policy. HO3 is your standard homeowners insurance, and we can help shop that for you. We'd like for your client to be the named insured, and we'll be additional insured on the HO3 policy. But we have a department now that helps vet this all out and work with you on that to make sure it's correct. But some states necessitate that you have to have a renter's insurance policy by virtue of the agreement.
Got it. And in terms of, you said the majority don't. Or are we talking 4 or 5 states? 10
Yeah,
states?
just a handful of states.
A handful?
Correct.
Got it.
Yeah.
Awesome. Who underwrites the whole deal?
So great question. So the FHA loan is underwritten by Travisa, right? So they're underwriters. And what does that consist of? Since they're underwriting a tribal entity, there's no income, there's no assets, there's no credit history, there's nothing like that. They're just basically underwriting the collateral. So that's really all they do. And that part's fairly easy. It's actually it's kind of a weird loophole. Like government entities can buy as many properties they want and they can be approved on as many properties they want. If you want to be like a property investor, figure out how to own a government entity and you can go buy tons of properties, right?
I'm working on it.
Yeah, exactly. So it's a guaranteed approval. They have to submit with the homeownership center to get it all approved, but that part's guaranteed. As far as underwriting the client, we do that. So basically what will happen is you will facilitate this by giving us a certain piece of information about the client. And then we run them through our ability to repay calculations and our guidelines and whatnot to see if they're somebody that's good for the agreement.
Let's talk about a little bit about ability to repay. You mentioned earlier bank statements. How many months to qualify?
3 months as a minimum.
3 months bank statements as a minimum. So if we have a consumer that for whatever reason filed his taxes XYZ way, but needed ABC way,
Right.
obviously taxes are out the window. We can document over the last 3 months that these bank statements work. There is an option for them, correct?
Correct. Yeah. And so I like to call it, in mortgage, you have to communicate things really quickly, right? So I call it 333. And it's basically if I can get 3 months worth of bank statements with solid income, right? I've got 3 months worth of reserves in addition to whatever it takes to close the transaction, and at least 3 months worth of verifiable housing history, then that's typically a client we can work with. And that's kind of the easiest way. Like loan officers, I think, want to know what the outer limits of the program are. That's the outer limits of the program. It's not always that way, but like if you have those 3 things, typically we can make something happen there.
That's amazing. In terms of the seasoning of funds to close, what's that look and how's that compared to your standard FHA loan?
So we've changed this up a little bit on seasoning, but I don't think that we have a seasoning requirement currently on this. Actually, Monique would probably be able to.
No, you don't.
We don't have a seasoning requirement.
You don't have a seasoning. No.
We beat it up every once in a while, but no. Currently,
Now, yeah. Now, if there's, a large deposit that happens within, weeks of closing, the underwriters would sometimes like an LOX just to identify where it came from and if it was money that they were saving at home or, something of that nature, but there is no source or seasoning.
You can tell it's nice that I can defer to one of my clients because she knows the program so well. So thanks for your expertise on that because I don't get involved in some of that stuff.
You can call me anytime, Shawn.
Love it. Love it.
Shawn, Lydia was asking, can you go over the 333 one more time? She's got the, go for it.
Yeah. So, 3 months bank statements with solid income. So I can prove my income via the bank statements. I got 3 months reserves. So whatever it's going to cost to close, and I'm going to have reserves left over at least 3 months. And then 3 months worth of housing history through those bank statements or whatnot.
Oh, some kind of VOR or something that can document.
Yeah. And VORs are a thing like, right. So if it's a private party VOR, then we typically want more documentation. But again, the minimum requirement is if I can show 3 months bank statements and show those rent payments coming out consistently.
So it really does sound just like common sense lending.
It really is. It really is. It's a straight manual underwrite. We have a credit committee where we get together on all suspensions and denials and we beat up deals. And we basically say, how can we make this work? We're kind of business guys. So we've had deals that are kind of screwy, but they have a 60% LTV. And the answer is yes. We've had deals where, they got no credit score, but we can verify basically, alternative trade lines on them and kind of establish a payment history there. And they've got really fantastic income. We say yes. We love this portfolio. We own over 3,000 properties right now. And we're doing something right, because it's definitely better than our normal down payment assistance portfolio in terms of slow pay, default, all of that. It's less than
So I was going to
2%.
touch on that next. What kind of performance are you seeing out of it? Are consumers put in a position to own their home for a long time without much concern?
Absolutely. Yeah. I mean, so it's better performance on these, again, less than 2% default. And that's partially because of the community, like the demographic that we're dealing with typically are scrappy, they're savers, they have multiple streams of income, that kind of thing. But like, it's amazing to me how many people that are self-employed and the amount of money that flips to their checking accounts, and they're paying their money out the window on rent. You know what I mean? They're not taking advantage of it because they haven't been able to amass the 20 whatever percent to do a non-QM or something like that. And so this is kind of a step in between that I think is a better
Yeah, I
option.
mean, I don't have the rates in front of me today, but even when you get into the non-QM stuff, you're talking about 10, 11, 12%,
Yeah.
significantly less here.
Yeah, absolutely. Yeah. So you're 8%, you know what I mean? Something like
Right.
that.
Yes, I
Uh,
think depending on where you're at, you're looking at low sevens, mid
yeah.
sevens. I think our highest is a low 8.
Yeah.
Compare that to your standard I-10 stuff or your standard non-QM stuff, you're picking up another 3 or 4 points behind that.
Yeah. And then the amount to get in, again, you're about 5.5 to 10% all in to get in. That's
Right.
down payment, closing costs, our fees, everything. 5.5 to 10 is about where you are.
We got 2. We got one from Cassandra, who I think knows you. Shawn, is this different from your previous company's program?
So you mean how do I say this? Yeah. Yes, it is.
I'll let you simmer on that one while I give you Juanita's. When pre-qualifying the borrower, do we calculate it on a 40-year amortization?
No, it's kind of interesting how we do it. Basically, you do need to understand how we calculate payment, right? And so basically, you take the total loan amount, you multiply it times half a point, divided by 12, add that to the payment.
Oh God, I hope this is recorded, guys.
Yes. So basically, just add half a point divided by 12, whatever that amount is, you add to an FHA payment. That's what their payment amount is going to be every single month. That's the way to do it. It's
Easy
just kind
enough.
of a quick deal. Yeah. So total loan, half a point divided by 12, add it to the payment. That's what they are.
Juanita
Don't try to amortize this in an LOS. Don't do that at all. You're going to do a 30-year fixed FHA in your LOS or whatever system you guys provide, and generate a CD for a government entity. You're actually getting paid to originate a loan for the government entity, right? And then you facilitate this other thing that's happening, and we kind of work in the background to make that happen. But technically, you get paid to originate a loan for this government on behalf of the government entity.
Got it. We got two cool ones, I think. And Kevin, I think I know the answer to this because we do a lot of these, but I'm going to let Shawn jump into this. If I had a buyer that has 3 collections that total about $5,000, but has good income, score of 610 or better, would something like that work?
Sure. So give us a letter of explanation of what the collections are. Like, if they just irresponsible, there's got to be a story with it. It sounds like their credit score is on the up and up if they've had that many collections. Are they in repayment plans with them? What do their assets look like? We're going to make a decision and basically say, okay, they're moving in the right direction.
Yeah, so I got asked to be a moderator on this or a panelist on this because of the success we've had with your program and a combination of Travisa. And I think clients like this are the ones that we love up and not, because something like a simple 3 collections, so you don't qualify for typical financing. This program opens the door to home ownership for you.
I mean, I'll give you a personal example. So when my daughters were in high school, I started a secured credit card for them, First Progress. It used to be a great little program. You put in $200, they report to the credit bureau every single month. And then once a year, they hit you for like a $40 fee that you have to re-up, right? And you forget about it, right? So I forget about it. And I've done that for my daughters so I could have them build their credit report, build their credit stuff. Well, this stinking company decides to sell to a different company, a different credit card company. So the website that I typically use to access it no longer exists. We have to re-register. I'm not on automated letters. I do it all via online. And so I don't realize that potentially I'm late until I start getting texts and saying, hey, you need to make a payment on this thing. And then I try to go in and it's like a nightmare. We're talking a $40 payment with a guy that makes plenty of money to handle this. But potentially, if I don't manage that appropriately, and because of the kind of the situation, I could have a 30-day late.
Yeah.
You know what I mean? And that kind of stupid stuff happens to a lot of people. And this is a program that says, we don't really care about that. If you need to make a move on a property, we can help you. And you all have stories. You all have horror stories.
We got a bunch of cool questions coming through. And is 3.5% down always the down payment option?
Yes, it is always the down payment option. So one of the things that I'll make this announcement now because I said I would with Monique when we teased this the other day, right? So it was kind of confusing, right? That we had a confusing dynamic how we do this. And so what I'll tell you is when we go back to the down payment assistance land, Okay. When I go back to down payment assistance land, if I take a normal FHA loan and I securitize that FHA loan, right? I'm going to get, whatever. I'm going to get X when I securitize it. If I put a non-subordinating second and attach it to that first mortgage, I'm going to get X plus quite a bit of money. It's called a spec pool pay up, right? And so you remember, we will allow you to pay off that second mortgage at any time on DPA, but we won't allow you to subordinate. That non-subordination clause works like a prepayment penalty. And what that does is that creates the broker dealers that buy FHA loans in the secondary markets, they pay up on those FHA loans when they know they have that non-subordinating second attached, because it keeps people on the books longer. So that little function right there helps us optimize the security. So Travisa, when they securitize, they're able to make more money, get better pricing, offer lower interest rates, all that kind of stuff that happens. And what we had to do initially when we started this program is we had to have like a little trickeration. Like we were doing an audible, we were doing, I don't know, misdirection basically in the backfield, where we said, okay, from one entity of the tribe is going to give a down payment to the other entity of the tribe. And we had this 1% second that was in there. It didn't help or hurt the client. It only helped the optimization of the security. I hope I'm making sense to everybody, but basically, because of that 1% second, when Travisa securitized it, they made more money. And that was what the goal was. And it was a huge hassle because people had to explain it to people. They didn't really want to know about it. They were like, what is this? They'd accidentally give them the CD. They'd say, oh, I only have to pay 2.5% down instead of 1, or instead of 3.5, because I got this 1% second. That thing has now gone away. We have enough broker dealers and buyers that we've been successful with this program that they no longer require this. They know that the runoff rate is going to be great with these loans, and they will give us the pay up without having the second mortgage attached. The second mortgage is kind of a trick anyway, but we don't have that any longer. So now you don't have to worry about that little dynamic in handling this anymore. And then the next step.
Assuming most of the people on this call haven't had to deal with it because they're just starting the program. So brain dump it, just know the program got better.
It got better. And so, yeah, for you, Fernando, I mean, you had to deal with it, right? Like you had to sell this stupid stuff, and it was always a hassle, right? People would always, if they found out about it, they asked questions, and it just muddied the waters. We now no longer have that. The program got better. So they do have to do 3.5% down currently. They can get seller concessions to reduce all the closing costs on it. And then there's our fees, which you add on top of that. Okay. Our fees add a little less than 2 points. So that's why I say it's between 5.5% and 10% all in.
Loan amounts, max. Where is it at county limits, or how are you guys calculating?
FHA county limits are going to be the max on this. Unless you have a pretty good chunk, you can exceed that, right? By paying it down in the form of a down payment, right? But you're going to stick, and to be smart, you'll stick with the lesser of FHA county or national conforming. Because in some states like California, you've got a $1.2 million FHA county loan limit. National conforming is 806,500. Anything north of the 806 is high balance, so it gets very expensive. You can do it, but it just costs more money, right? So, but in no case will you go over FHA county unless they're willing to put in a substantial down payment.
We got a bunch of questions coming through. I'm going to try to get as many of as I can. Can you please discuss the 0.5 point fee and the 75 basis point fee that has to be paid by the borrower?
Yeah, I mean, so the 0.5 point, I'll tell you, that goes into what's a reserve fund for us. 75 is we collect that that's part of our margin. So we're doing
easy enough.
Yeah, easy enough. But 0.5 point goes into a reserve fund because heaven forbid we have massive, default and foreclosure, and we've got to pay those. So
Travisa, I'll jump into your question. Typical par rate. It does move with the market right now. I think 8.25 is given like an 80 basis point rebate. So they're kind of all hanging out between low sevens, where they do have to pay close to a point, and then at 8.25 they're getting almost 100 basis point rebate. Again, it kind of moves with the market.
Yep.
Does the buyer/renter receive an annual statement showing earned equity?
We have an amortization schedule that we publish, and we give it to them at the beginning of it. And so I think you can make a request, but I don't know that that's going out to everyone right now currently.
Yeah, I imagine, I'm sure you can show that your amortization schedule, like every other mortgage. Identifying how much equity a property has earned is going to be just very cyclical to market and very cyclical to property specific.
Right.
But knowing that if your market has jumped 10%, that 10% is in the home, we can kind of assume for it.
I would like to mention something that they do receive on an annual basis, and that is a interest statement. So they will receive a 1098 interest statement at the end of the year, and so they're able to write off the interest on their taxes.
It's awesome.
I just wanted to point that out.
Thank you.
Because it's another way of demonstrating actual ownership.
Correct. Yep, exactly.
Next up, I think this next piece is really important just because it adds so much validity. This is all HUD approved, correct?
Yeah. So, I mean, the HUD portion of it is that basically you always want to be careful saying something is FHA or HUD approved. But here's what I can tell you. In the guidelines, a government entity can purchase property as an investment. Okay.
Which is what we're doing.
What we decide to do with that property after we've purchased it is up to us, right? There may be some state considerations on the type of contracts that we have to issue for those relationships. But as far as HUD is concerned, every single one of these properties has gone to the homeownership center and has been has been insured by FHA.
I know we're really short on time and we have 5 minutes. I know, Monique, you had a couple things you wanted to jump in on. Do you have anything else? And Shawn, you've been amazing, bud. I know, thanks for jumping in kind of late. And
Sorry.
I know it was a bit of a mix up, but it was really informative. I know Monique had a couple things she still wanted to knock out. And, you know, for those that still have questions that are pending, feel free to shoot us an email or a text. Any one of the account reps will be able to assist you guys out. Go ahead, Monique. And thanks for having me, guys.
Yeah, thank you guys so much for joining us. I'm really glad that you guys were able to make it.
Oh, easy enough. I thought you had more.
I do.
Oh, okay, go for it. Yeah.
So real quick, I'm just gonna run through the slides that I have, because you're all gonna get a recorded copy of this. I just want to make sure that you have access to all the rest of these slides. Right here is just kind of where I left off explaining, you know, you have your government entity right here, front and center. And then on one side, you have your home seller with the FHA loan. Those three are going to be a combination. And then to the right, you have your home buyer that's linked with the government entity and the seller finance agreement. Moving on, a few of the EEP program highlights. Again, 3.5% down is the minimum down payment. They can always put more, but I think the entity likes to see reserves. So keeping their funds for reserves is always a good idea. We do have ITIN, non-permanent resident aliens, including DACA, low and no credit scores. So here at Travisa, we go down to a 580, and we also allow alt trade lines. We have those 3-month bank statements that Shawn was talking about. And it is not only for just self-employed, but it's for W-2 and 1099 with a DTI of 50/60. That no source and seasoning for funds to close we discussed. Bankruptcies is okay. And for Chapter 7, they only need to be out of the bankruptcy for 1 day. So as long as it's reporting on credit and we can show that the discharge has occurred, they can close the next day. So they can go out shopping, go house hunting, get all excited for that, and go ahead and close immediately after that discharge. We follow FHA guidelines for property types and the seller contributions of up to 6%. So when you're looking for the borrowers to qualify, you're looking for borrowers to qualify that don't fit in that traditional box as I discussed at the beginning, such as the ITIN, the 3-month bank statements, bank statement programs, low credit scores. For verification of rent, Shawn did mention the 333. That is minimum if you have somebody that can't fit into their traditional guidelines and they have 3 months reserves. Otherwise, it's a verification of rent for 12 months history. Employment, we need 12 months history of employment. And then gift funds are allowed. The seller cannot gift any funds, but gift funds can be pulled from all sorts of family members. Also, for the self-employed bank statement program, there is a standard expense ratio of 45%. They have come out with a tiered expense ratio, and this is for your clients that, you know, service-based, they don't have to buy any products, they don't have any employees. Hey, let's take a common sense look at this file and let's only hit them with the 10% ratio. But of course, also you do have your product business where you can document and show us that no employees or maybe just one, and products are very cheap. That's not a very big expense for getting those products, and you know their markup is a lot higher. In addition, want to mention that it is a full FHA appraisal. So if it comes back subject to repairs, we do need to see that those repairs are completed. And a home inspection is required for anything that is a condition of C4 or higher. In addition, if the property is a 1979 or older, then it also requires a home inspection. So those are definite things that you want to keep an eye out for. Pest inspections are also required depending on the state. There's 35 states that require a pest inspection. So when you're looking at your borrower and your purchase contract and, you know, your appraisal and those things, just keep in mind that that could add some days for closing. I just want to make sure that everybody is understanding and the expectations are set properly. So the again, Shawn really hit on this as far as, you know, the borrower's ownership rights. They definitely have a lot of ownership rights. They have the tax benefits. They have the right to the full appreciation. They can improve the property, sell it, and they're just building equity and that generational wealth through making payments and appreciation. Again, they did hit on the securing the rights interest. He did mention that there are POAs that now are associated with the homeownership finance agreement. And so it does make it a very difficult for the tribe to go out and sell the home. And again, this is not what they're trying to do. They really are trying to help people get into homes. Shawn mentioned the credit committee. When I was over there, I was part of the credit committee, and we would fight back and forth and discuss really they need to be in this home. They, you know, they have a lot of positive, strong points, and you know, sometimes people have stumbled, and so I just want you all to know that they really truly want people to get into these homes, and they're not looking at trying to sell them out from underneath them. So again, your takeout options are going to be assuming the FHA loan that the government entity has, selling the property, or again, new financing subject to the lender requirements. And ultimately, your target for your business and building your business, ITINs, this program is huge for ITINs, self-employed, seasonal fluctuations, denied traditional financing, 3 months bank statements, and we only do require one major credit bureau. So you pull credit scores and you only have the one score that's above 580, no problems. They touched on again that other ITIN markets, you know, you have to have anywhere 15, 20, 25% down. Travisa's earned equity is 3.5 with the 3 months bank statements. DTI is 50 over 60 with the 581 major bureau. This is just a little example of how a timeline can look for closing on a property. We had a borrower that was first-time home buyers. They were all ITINs. And we were able to get this closed when they were turned down for other financing. And we just, you know, the seller or the title company wasn't approved. So we were able to get the title company approved in record time. Termite and inspection had conditions on it. And so we really tried to get everything closed as quick as possible for you all. We do have other products. We have our FHA, VA, conventional USDA, and the Advantage DPA program that Shawn just went over with Fernando, and our earned equity program. We have a lot of support available for you all. We have our dedicated email address that is eepquestions@travisafinancial.com, and our dedicated phone line, 877-888-ASK-EEP. I believe that number goes directly to me, so if you have any questions, please feel free to call, and also the email address. So in addition to having your account executives, myself, we have our EEP hotline. We have weekly training and Q&A. I host webinars Mondays and Thursdays. You can bring any questions or scenarios that you have at that time. Again, we can set up your own private training through the account executives, and I'm always on those trainings. We want to make sure that you're successful. We have flyers. We will personalize these flyers to you, your picture, your logo, you know, whatever you need to succeed. We want to help in any way that we can. If you have any questions, please feel free to call the number that I gave you, call your account executives, email. But I'm so glad you guys could join us today. Thank you again, Shawn and Fernando. It was definitely a great masterclass today. Thank you, everybody. Have a wonderful day.